Welcome to Talking Business, a produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 17 in our series for 2022, and today's date is Friday, May the 27th. First, I'll be talking to Thoughtworks Director of Data and AI Practice, David Colls, on why businesses should adopt the creative use of artificial intelligence. And I'll be talking to Indeed economist Callum Pickering about the latest wages and unemployment figures. But now let's talk to David Colls.
Okay, well, David, tell us what is the potential for AI to identify unexpected innovations for Australian business? And why do organisations have to lean into creative AI?
Yeah, great question. I think that AI is often perceived as a tool for improving operations or customer experience, areas where there's a lot of historical data that can be used to inform predictive models. But there's another area which we describe as creative AI, which is more focused on generating content, generating product ideas, and generating strategic ideas. And I think that area has a lot of opportunity, and there might not be a lot of existing data, unlike the operational applications for AI. And this is where there's a lot of potential for Australian businesses. The design and innovation space can be a numbers game in some respects. There's the more experiments you can run, the more ideas you can test cheaply and with low risk, the more likely you are to find innovative opportunities in the product space and in business models and strategy. And if there's one thing that AI is good at, then it's scaling to big numbers. And I think that there's an opportunity to use the best of people's creative insight and talent, and AI's ability to search through big spaces and generate novel concepts in this space. And there are a lot of drivers for innovation at the moment. Ongoing adoption of new digital technologies, responding to climate change, responding to public health, and the COVID pandemic, and other economic factors. So the more that you can explore in these areas of uncertainty, the more opportunity you might unlock.
What particular sectors would be particularly good for AI?
So I think obviously in the digital space, the AI's ability to create content and is a place to look. Also, with the response to these emerging challenges, supply chain operations and customer service, looking at new models and using AI to assess their ability to serve customer needs.
So it would be particularly good, I would imagine, in the FMCG space.
Yeah, absolutely. And so, this is an area where, especially if you look at, say, electrification of fleets, then there's an opportunity to explore different distribution models and how that might impact emissions and your response to and your climate change strategy and sustainability response.
You've worked with Mackmyra, which is a Swedish distillery of all places. And
yes.
They used AI. Tell me, what did it do for them?
Yeah, great. Not me personally, unfortunately, although I have consumed a bottle of the whiskey, and I can highly recommend it. The Thoughtworks is a global consultancy, and so the Finnish part of our business, based in Finland, worked with Mackmyra in Sweden to develop this whiskey. This was very much a partnership with the experts and the distillers, and this idea of innovation being a numbers game, but also a human game combined was how we approached this engagement. And so the team looked at all the decisions that go into making a whiskey. So you can imagine that, like, the selection of grain, selection of peat, the selection of a cask, the time and process characteristics, that all boil down into numbers that could be captured in one model, which is the generative model. So here's all the different ways that we could put a whiskey together. And then they also looked at how consumers perceive different whiskies. So, tasting notes, preferences for flavors. And so from this aspect, they could build what we call a discriminative model. And so this model could tell us how good a design was. And so using these two models, as well as the human expertise, we're able to explore a much wider range of potential whiskies. And under the guidance of a master distiller, select one that proposed by the AI that looked like like it would be a good fit for consumer tastes and a new blend that hadn't been introduced to the market as yet.
So basically what artificial intelligence did for McMyra was take all that data and help turn it into a new model, a new business model. Is that right?
Yeah, precisely. Yes, a new product in this case. So adding to their lineup of whiskies by exploring a space that hadn't occurred necessarily to the human distillers yet, but was able to be discovered by rendering the problem in a way that was suitable for an AI to explore the product space and come up with new ideas.
I would imagine, yes. I would imagine that. Well, you've got McMyra, but you would have all sorts of consumer products would actually benefit from this.
Yeah, absolutely. Yeah, I mean, you can look at any product in the same way as the team did at McMyra as a series of design decisions or design parameters, and then you can try and characterize its performance in the market as a test or as a model that can be run, and then for any product, any physical product, but also services as well. So we can look at the service characteristics and customer experience. These are also things that can be parameterized and that we can test with models. And so any product or service, we can start to think about it in these terms that allows us to identify previously untested opportunities or untested designs.
I would imagine it would be very good for retailers too, wouldn't it?
Yeah, but very much. So yeah, I mean, if you look at a retail, and you could look at a retail product catalog through the same lens, and you can identify areas where there are potentially gaps in the product catalog with these sorts of techniques as well. So we might have a range of shoes, and there might be another style that's emerging in another part of the catalog, say jackets, and it might be that the AI is able to identify some common thread between two different elements of the product portfolio, and it's not about entirely turning the decision over to an AI, but it's about providing insight to to people who are working in product design, innovation, ranging, those sorts of areas.
Well, not only for goods and for items selling goods, but I would imagine for companies selling services like banks and insurance would do fantastic.
Yeah. So again, this is often where there's a focus on AI supporting operational decisions, but it can also be used to inform the design of financial services products and services. I was looking at a banking app the other day where there's a budget management feature, and thinking about how this is an example of AI helping people with a strategy to achieve an objective. And we've also worked in delivering customer service in the design of call center experiences as well. So being able to simulate whether we're able to meet customer expectations with a particular design for which agents handle which calls in a call center.
What could AI do for employees? I would imagine it could actually boost morale.
Yeah. Well, I mean, in this creative space, it can be like working with another creative partner, who has particular abilities in a space in a design space, and so you can use these tools in a way to help you come up with more ideas that you might not have thought of yourself. You can use them to help you develop those ideas faster and to improve productivity, and you can use them to test ideas, to get fast feedback on ideas that might otherwise take some time to validate.
And it would also be great for keeping employees on board. Stop them leaving the company, wouldn't it?
It provides it provides a number of avenues for development and growth and ongoing learning, which is very important for people. As in the current climate, we talk about the Great Resignation, and people are evaluating what's important to them. And this sort of work is a multidisciplinary type of work that brings many different roles together: product, business, technology, and data and analytics.
I would imagine, a final question is, I would imagine COVID and lockdowns would have actually helped precipitate this interest in AI. Would that be right?
Yes. Obviously, COVID's impacted the development of AI solutions in a number of different ways. Obviously, a lot of focus around video and video content as a way to connect to people. And so, I guess channels of communication and channels of distribution have become a lot more digital in the COVID world. And these also provide more opportunities to instrument the experience and to augment the human connection with AI as well. So we've also had to adapt models very quickly. Price was a primary indicator prior to lockdowns. Availability is now sort of a primary indicator of product performance in the current world.
Right. Okay. Well, Dave, that's all fascinating, and thank you very much for your time.
Oh, you're welcome, Leon.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, the unemployment figures came in at 3.9%. It's like the labour market is getting very tight.
Well, that's exactly right. It's the tightest labour market we've had since 1974, so almost 50 years. Employment gained only slightly. In April, it was only up about 4,000 people, but I think that's going to be increasingly the reality of what the Australian labour market looks like as it continues to tighten. That is some of the big employment figures that we have seen over the past couple of years, particularly over the past 5 months, probably aren't sustainable long term. And so we're going to start seeing monthly increases of employment of, 5, 10, 15,000 people. But in a really tight labour market, that's going to be enough to drive the unemployment rate lower, which is what we expect to see. Don't be surprised if the unemployment rate is nearer to 3.5% come the end of 2022. So very tight labour market and certainly heading in the right direction.
Now, those lower employment numbers would also be because the population growth has been very modest, hasn't it?
Well, that's right. Before the pandemic began, Australia's population was growing, between 1.5% and 2% per year, depending on the state that you live in. It's been very subdued over the past couple of years. Some states barely growing, other states only growing by a little bit. The working age population is currently increasing by about 0.6% over the past 12 months, so very different from that 1.52% range that we were accustomed to. Now, what that basically means is that that's basically the reason why we're unlikely to see these really strong employment figures continue month on month, and we're going to see a marked slowdown in employment growth going forward. But even though that's likely to happen, it's still going to be sufficient to bring the unemployment rate down.
The other thing would be driving it would be stuff like job vacancies. They're around record levels now.
Well, that's right. It's a really interesting dynamic at the moment. We have an incredible number of jobs available, record vacancies. At the same time, we have very slow population growth. And when you combine those two things together, what you end up with is a very, very tight labour market, which is precisely what Australia has. And it's a large reason why we have seen the labour market tighten so quickly. The recovery has exceeded all expectations. Policymakers have had to upgrade their economic forecasts again and again and again. And as long as population growth does remain quite low, it is likely that we are going to see further tightening in the Australian labour market. Some of these vacancies are going to be filled. Others probably aren't going to be filled in the current labour market. But even still, you're going to see a much tighter labour market over the next 12 months.
Or it's going to be pretty challenging for recruiters, though, with the low population growth and fewer entering the workforce. They're going to be struggling to fill those positions.
Well, that's right. It's a really challenging environment for recruitment right now. The dynamics in the labour market have shifted from being in favour of the employer to being in favour of the employee. Job seekers have more bargaining power in terms of wages, in terms of where and how they work. There's a lot of opportunities out there for job seekers. But from a recruitment perspective, you're getting relatively few candidates. Jobs are harder to fill. Jobs are remaining unfilled for longer. And as the Australian labour market continues to tighten, those difficulties are only going to increase.
Well, we were talking about wages, but wages only went up 2.4%, and the inflation rate's 5.1%, so it's 2.7% gap. That's quite bad.
Yeah, it's far from ideal. So real wages, wages adjusted for inflation, fell by 2.6% over the past year, which is the largest decline we've seen since the introduction of the GST. Wage growth has certainly not increased as fast as anticipated. I think most economists would have thought that we'd have seen a bit more of a wage breakout by now. Certainly policymakers thought that. It hasn't quite eventuated. Now, if we dig a little bit deeper into the wage figures, we can begin to see some wage pressures develop. So wages rose in only 15% of jobs during the March quarter, which is perfectly normal. But the average increase for those jobs was 3.4%. So those jobs received a 3.4% pay rise. So that was the highest since June quarter 2013. So we are beginning to see some wage pressures build in recently negotiated jobs. So as that flows through, as we see, more jobs have wage increases in June, and then about half of all jobs receive a increase in the September quarter, we're going to begin to see wage growth push towards that 3% level. Nevertheless, when you've got inflation of 5%, that's still not going to be ideal from an employer perspective. So it's still a very difficult situation, even if it is likely to improve over the next 6 to 12 months.
I mean, the other issue too is the unemployment rate for women. I mean, that's pretty low. That's at 3.7%. That's the lowest rate since 1974, isn't it?
That's right, near 50% low for women's unemployment. That's going to put a lot of pressure on industries that typically attract a lot of women. So I'm talking about industries such as healthcare, aged care services, even retail and hospitality, which do hire a very large share of women. It indicates that hiring and recruitment in those industries will become very difficult. Skill and talent shortages will emerge or become exacerbated, and it'll be interesting to see whether that translates into higher wages in those industries.
Well, it's interesting because these industries are struggling to source sufficient staff.
That's right. I mean, conversations I've had with businesses in those industries indicate that it's an incredibly difficult recruitment environment right now. I mean, we just spoke about how the women's unemployment rate is incredibly low. We also need to bear in mind that for some industries such as retail and hospitality, the population of young people in Australia has actually declined throughout the pandemic, which means they've not only had this incredible increase in demand for workers, but the actual supply of potential employees has declined significantly. And you combine those two factors together and you end up with an incredibly difficult time trying to find suitable candidates to fill a lot of these roles. There's a lot of restaurants, there's a lot of retailers who are understaffed right now, and they're not entirely sure when that's going to change.
Well, underemployment among women also was declining.
Yeah, so this is another good story. So underemployment among women is down to 7.4%, which is actually around the lowest level in 3 decades. And what that means is that a larger share of women are getting the hours that they want. So we don't have the same number of women working part-time, only getting, say, 15 to 20 hours when they prefer to be working 25 to 30. So a consequence of this very tight labour market is that businesses are often turning to existing staff, offering more hours to those existing staff, or they're trying to attract staff from elsewhere by offering more hours. And those dynamics are basically driving the underemployment rate down. When we assess tightness in the labour market, it's always good to look at the unemployment rate and the underemployment rate, and those two are moving in lockstep at the moment. So this very strong demand for workers that we have is driving both of those down. That's a great outcome. That's precisely what you want to see.
Right, okay, but it also means a lot of these industries will be offering women second jobs, won't they?
Well, second jobs is part of that, yeah. Obviously, you can increase your hours by taking up, performing more hours at the job you work at, or you can take on an additional job. We have seen that secondary jobs have increased recently. They're about 6.6% of all jobs in Australia. And the likely reason for that is because there are those opportunities out there. Now, there is a possibility going forward that there might be a lot of people taking up second jobs because of rising inflation, rising cost of living pressures. So that'll be an interesting dynamic to keep an eye on over the next, 3 to 6 months.
Now, the issue too is that COVID is still affecting Australia, and is that impacting the hours worked?
Well, it certainly is. So 5.1% of workers in New South Wales, Victoria and Queensland worked fewer hours than normal due to illness and sick leave in the month of April. And the impact was actually even greater in the other states. It was about 6.9% of workers. Now, this is highly unusual. This is well above what would normally be the case. And it seems as though this sort of COVID impact on hours worked is something that's going to persist with us until case numbers get down. The simple fact is, if you have a lot of cases, a lot of people isolating at home for a week or two, it's just going to have a big impact on hours worked across the economy, which could potentially weigh on economic growth. I guess we'll see once the March quarter GDP figures come out, what sort of impact this heightened sick leave is having on overall economic activity. But it certainly seems likely that it will have at least some impact.
Now, in view of the lower wage growth figures, but in view of the tighter labour market, where do you see the RBA going? Do you see them still raising interest rates?
Absolutely. I mean, they anticipate that inflation will get to 6% by the end of the year. They're also anticipating that wage growth is going to pick up. So in order to address that, they are going to have to hike rates pretty aggressively over the remainder of the year. I would expect rate hikes in most of those meetings through to December. So rates will be much higher come the end of the year than they currently are.
So where do you see rates finishing this year?
Great question. Obviously, there's a fair bit of uncertainty around that. I would expect somewhere between 1.5 and 2%.
Right, okay. And, of course, it's going to continue into next year. And, people like Shane Oliver and the RBA are talking about it peaking at about 2.6%.
Yeah, that's certainly a possibility. Now, obviously, there's a huge amount of uncertainty around this. Inflationary pressures could begin to diminish depending on what happens with the war in Ukraine. Maybe supply chain disruptions begin to diminish as well, and suddenly inflation is no longer as big a problem. But based on everything we know at the moment, we're expecting an elevated inflationary environment, some of the largest inflation figures we've ever seen, and that's going to require a pretty aggressive response from the Reserve Bank to contain that.
Okay, well, Callum, thank you very much for your time.
And thank you, Leon.
So what's happening in the news? Well, the financial leaders of the world's most powerful countries warned this week of the potential for a global economic slowdown as the threats caused by Russia's invasion of Ukraine continued to multiply. Globally, the war is sending energy and food prices soaring. In the United States, Britain and Europe, central banks determined to curb inflation are moving to hike interest rates, which risks pushing nations into recession. The developing world faces an emerging debt crisis on top of a growing hunger problem sparked by the war. After approving trillions of dollars in fiscal stimulus to avert the downturn caused by the coronavirus pandemic, world economic leaders are now grappling with the threat of stagflation, slow or negative economic growth, coupled with rising inflation. The World Bank has also warned of a huge build-up of debt, particularly in the poorest countries, with debt payments at their highest level in 20 years. Half of low-income countries are now categorised as being at high risk of debt distress, according to the Centre for Global Economic Development. And Russia's war in Ukraine will unleash the worst food crisis in recent memory across vast swathes of the developing world, with the potential to create hell on earth for some countries, the World Economic Forum in Davos heard on Monday. As Ukrainian officials, including President Volodymyr Zelensky, battle to find ways of breaking down a Russian blockade of their exports, a WEF survey of chief economists says the crisis is triggering export restrictions worldwide that will make things even worse. The survey also revealed that most chief economists reckon Europe is staring down the barrel of stagflation this year, while in the US and Asia Pacific there is more prospect of economic growth even as prices surge. According to the survey commissioned by the Switzerland-based WEF for its annual summit in Davos, about 80% of chief economists predict the Middle East and Africa are facing insecurity or high insecurity in their food supplies over the next 3 years. The UN Food Agency's executive director, David Beasley, warned in Davos that some countries could face hell on earth this year if Ukrainian exports did not resume. Both Russia and Ukraine are major exporters not only of wheat and vegetable oils, but also of fertiliser, which could create spillovers into other crops. And the risk of widespread wage rises of more than 5% is the number one threat to the economy, employers say, as they urge the Albanese government to use its upcoming jobs summit to restore the Hawke-Keating enterprise bargaining system to boost productivity. Australian Industry Group Chief Executive Ines Willox on Monday said businesses were under pressure from unions pushing across-the-board wage rises at an unsustainable level for many businesses, citing the ACTU's call for a 5.5% increase in this year's minimum wage. Willox cautioned that the latest data showing sluggish wage growth of 2.4% does not really reflect what is really going on with workplaces. It's very common to hear employers talk about giving workers 10, 20, 30% pay increases to retain staff because of the job shortages, he said. However, he welcomed Prime Minister Anthony Albanese's commitment to reforms that increase productivity. And big business will put changes to the Better Off Overall test squarely on the negotiating table when it meets with unions and the new Labor government during Prime Minister Anthony Albanese's employment summit. The government faces one of its first ideological and economic tests in submitting its case for an increase in the minimum wage to the Fair Work Commission by June 7. But it will confront another when employers revive the debate over enterprise bargaining after Labor forced the coalition back down during the election. Albanese named the promised employment summit as being high on his reform agenda during his first parliamentary press conference as Prime Minister on Monday. The Better Off Overall Test, or BOOT, a key workplace system safeguard that ensures workers don't go backwards during pay negotiations, requires each individual worker to be better off under the terms of any new enterprise agreement than under the industry award for it to be passed. During the election campaign, Albanese accused Scott Morrison of putting workplace conditions up for grabs when the then Prime Minister revived his commitment to the Coalition's shelved industrial relations package, which included changes to workplace bargaining that Labor and unions argued would lead to some staff being paid less. And Australia's new Treasurer, Jim Chalmers, said almost out of control inflation was a major challenge for the economy, and record budget deficits would constrain the Albanese Labor government's spending capacity. Treasury Secretary Stephen Kennedy on Sunday afternoon met with Dr Chalmers at his house in Logan in Brisbane's outer suburbs to provide the incoming government briefing known as the Red Book. He also met with the regulators and other key stakeholders after being sworn in as Treasurer on Monday, which included leaders of the Corporate and Competition Watchdog as well as the Reserve Bank of Australia. The incoming government will inherit a strong economy being buffeted by global forces beyond its control, annual inflation set to hit almost 6%, more than a decade of deficits, and gross debt set to exceed $1 trillion. Dr Chalmers said when it came to managing economic challenges, it wasn't a case of flicking a switch and everything being better overnight. Labor committed to an additional $18.9 billion in spending promises ahead of polling day, as well as $11.5 billion in savings and revenue measures, leaving the budget about $7.5 billion worse off over the forward estimates. That will add $224 billion in forecast cumulative deficits over the next 4 financial years, which will take gross debt north of $1 trillion. And Anthony Albanese's history as a consensus builder has given business some confidence that Australia can move forward, just like when everyone, including Canberra unions and government agencies, was pulling in the same directions at the start of the COVID crisis. Most of all, chief executives are relieved that Australia looks to be on track for a stable majority government, while also encouraged by the rise of the teal independence movement in Australian politics as a potential counter to Labor's union-backed instincts. Labor has a longer-term ambition to convert these teal voters to their side. Outside of the climate demands, many of the teal candidates based in former Liberal strongholds in the cities are aligned with the aspirational values of the Business Council of Australia, ranging from tax cuts for individuals and business to lighter regulation. While the business links of Albanese and his incoming Treasurer Jim Chalmers don't run as deep as the outgoing Morrison government, the new Prime Minister forged strong contacts through his former ministerial posts in transport and infrastructure during the Rudd-Gillard governments. This includes names such as Qantas boss Alan Joyce and Sir Rod Eddington, who at the time was the inaugural chair of the Canberra-backed Infrastructure Australia under Albanese. Meanwhile, Sam Mostyn, the chair of Citigroup and a Mirvac director, remains a public supporter of Albanese and attended his victory celebration in Sydney's Inner West on Saturday. This is critically important, as Mostyn is also the chair of the hyper-connected Chief Executive Women organisation, which counts hundreds of the nation's top female executives and directors as members, as well as having significant links with Corporate Australia. Corporate Australia is under no illusions that the Albanese-Chalmers partnership is promising to be a pro-business government, but given lessons of the COVID years and new challenges ranging from hyperinflation to slowing global growth, a cooperative approach would be welcome. And China must remove its sanctions on Australian products to have any chance of improving relations between the two countries, Prime Minister Anthony Albanese has declared after joining the Quad Summit in Tokyo with regional leaders to endorse a firm line against Chinese coercion. While Chinese Premier Li Keqiang sent a letter to Albanese on Monday to congratulate him on his election victory and seek sound and stable relations, Albanese responded with a pointed remark about Chinese restrictions on imports of Australian coal, barley, wine and other products in recent years. With regard to our relations, Australia seeks good relations with all countries, but it's not Australia that's changed, China has. It is China that has placed sanctions on Australia. There is no justification for doing that, and that's why they should be removed, he said. Treasurer Jim Chalmers hosed down suggestions that the relationship with China would take a turn for the better under the Albanese government. Chalmers has told the Seven Network's Sunrise program the relationship was complex to manage before Saturday and would remain so. And Australian carbon credit prices have staged a major recovery after Labor's electoral win, but uncertainty still lingers over the medium-term outlook as investors in Australia's biggest companies wait for details on more aggressive emissions reduction goals, including a tougher safeguard. The spot price for Australian carbon credit units has soared 20% in the last days to $36 a tonne. Investors are betting on rising demand with a greater number of Australian polluters expected to tap credits as Labor tightens the baseline for the safeguard mechanism, its signature climate change policy. Like energy contracts, carbon credits can be bought and sold among big emitters to help companies lower risk and keep on path to net zero emissions. Westpac is buying carbon credits to hold on its own balance sheet, which are used by big customers looking to offset their carbon footprint. The desk is also involved in sustainability financing, including arranging green bonds on behalf of customers. Despite this week's bounce, prices remain nearly 40% lower than February levels, when the market crashed after former Energy Minister Angus Taylor allowed fixed carbon contract holders to exit their deals with the Commonwealth to access higher prices in the secondary market. And employers may be required to train staff to speak up about workplace sexual harassment with a view to preventing it, or at least intervene earlier and deal with power imbalances without excluding women under a legislation committed to by the new Labor government. The amendment, known as a Positive Duty to the Sex Discrimination Act, stems from Labor's pre-election commitment to fully implement all 55 recommendations from the Human Rights Commission's landmark Respect at Work report by Sex Discrimination Commissioner Kate Jenkins, released in March 2020. Workplace, business, legal and gender equality experts welcome the commitment, but warn there needs to be proper funding and measurement tools to ensure they are successful. A positive duty will require employers to take active steps to try to eliminate sex discrimination, sexual harassment and victimisation. Maurice Blackburn National Head of Injuries, Liberty Sanger, said a positive duty would make it crystal clear that when it came to workplace sexual harassment, it was the employer's responsibility to make sure the workplace was safe. And Eck Australia will list a fund tracking the price of carbon across 4 global emission trading schemes on the local share market, as the investment manager moves to meet surging demand for green portfolio exposures, it said, was reinforced by green and teal election victories. The local arm of the US $85.5 billion, that's Aussie $120.1 billion, Wall Street investment firm on Monday lodged an application with the Australian Securities Investments Commission to launch the Eck Global Carbon Credits, or ETF, synthetic, on the Australian Securities Exchange. Claiming to be Australia's first listed retail fund of its kind, and the first globally for Eck, the ETF will invest in futures linked to the price of carbon credits, which are permits issued by governments allowing companies to offset their carbon or greenhouse gas emissions. The pending fund will track a new Aussie dollar version of the ICE Global Carbon Future Index, which is made up of carbon prices from 4 of the world's most established markets: the EU Emissions Trading Scheme, the UK Emissions Trading Scheme, California's Western Climate Initiative, and the Regional Greenhouse Gas Initiative of the northeastern US states such as Connecticut, New York, New Jersey, Maine and Massachusetts. And funds under management in the industry super sector have surpassed $1 trillion for the first time on record, despite a rout in global equity market causing the super system to contract in March for the first time in 2 years. Funds under management in the super system fell to $3.44 trillion from $3.47 trillion in March on the back of the depressed equity market. But the industry super sector defied the crunch, with assets under management increasing 13.4% to $1.1 trillion, according to data released by the Australian Prudential Regulation Authority. It means that industry super funds manage almost 1 in every $3 in the super system. And AGL Energy has been hit with a fresh attack following Labor's election victory, with billionaire Mike Cannon-Brookes saying the company's demerger plan was not aligned with Paris Green goals and at odds with the nation wanting stronger climate action. Over 55% of investors last year voted in favour for AGL, Australia's biggest polluter, to set short, medium and long-term decarbonisation goals, despite it telling shareholders to vote against the resolution. Mr Cannon-Brookes, AGL's largest shareholder, is fighting a planned separation of the company into separate retail and generation businesses and wants to quit coal by 2035 to meet Paris Climate Accords, a pact to keep temperatures growing less than 2 degrees from pre-industrial levels, with an aim of limiting rises to 1.5 degrees. And Qantas has bought a majority shareholding in Byron Bay-based online travel booking website TripADeal for an undisclosed sum, as it targets double-digit earnings growth in its frequent flyer segment this financial year. The deal also includes options for the airline to buy the rest of the business in 4 years' time from other shareholders in the business. Qantas said the deal would be accretive to earnings targets for the frequent flyer business, which in addition to the growth targets for the year ending June 30, is aiming to earn from $500 million to $600 million by the 2024 period. And a major cost-cutting program weakened Star's risk and compliance function, outgoing Chairman John O'Neill said during his second day before a Royal Commission-style inquiry. Mr O'Neill drew parallels between Star Entertainment and the Banking Royal Commission, telling the inquiry, like the banks, were underdone on risk and compliance, and he said a pre-pandemic cost-cutting program hindered that progress. Mr O'Neill also said Star was not alone, with rival Crown Resorts increasing its risk and compliance team from 30 to 130 people. And the local arm of US tech giant Facebook paid just $24 million in tax last year, despite raking in advertising revenue of $1.1 billion, most of which was sent offshore, according to financial results filed with Australia's corporate regulator. Facebook's advertising revenues surged to $1.12 billion for the year ending December 31, according to the company's latest financial filings, up from $746.6 million in 2020. The company also posted a pre-tax profit of $61.1 million, nearly doubling from $37.9 million a year earlier. It booked just $24.2 million on tax in 2021, up slightly from $20.2 million a year earlier, with the majority of the company's revenue, $949.3 million, sent to an offshore subsidiary for purchasing advertising inventory. That was nearly double the $559 million in revenue sent to its offshore subsidiary a year earlier. The company pays for advertising inventory to other related parties in accordance with an advertising reseller agreement, Facebook said in its financial disclosures. Facebook and Apple have come under increased scrutiny for diverting hundreds of millions of dollars in revenue away from Australia to other jurisdictions. Last year in July, Australia and New Zealand agreed in principle to a new tax scheme negotiated by the OECD, which would come into effect in 2023 and would target 20 to 30% of the net profits of larger multinationals engaged in automated digital services like Facebook. Some countries currently impose a direct digital services tax, but Australia does not. And that's it for this week. And next week I'll be talking to Brisbane-based entrepreneur Tim West, who is behind Aussie boxing gym startup Ubox, which has sealed an $88 million UK expansion deal. And I'll be talking to economist Saul Eslake about the economic challenges for the Albanese government. In the meantime, you can catch me on Facebook, Twitter, Instagram and LinkedIn. And if you want, leave a comment. Wishing all a safe and healthy